If you are an investor in dividend stocks or thinking of starting investing in dividend stocks, then please stop right now. People who invest in dividend stocks, they think they are getting passive income. Also, they think that this is a safe investment. There is no risk in that. Of course, risk cannot be eliminated. You can only shift it from one place to another. If you don't know what dividend is, or you know, so this is a refresher for you. Dividend is amount of money paid to the shareholder of a company stock. So for example, let's take Microsoft. So if you're holding Microsoft stocks, meaning you bought the stocks and you're holding it in your account, then usually quarterly you get paid a dividend per share. So if you're holding 100 shares, and they pay you $1 per share, then you get $100. Dividends usually run between 1 and 4%, and that percentage is calculated as the amount of dividend divided by the share price. So when the price of the company goes up, if the company doesn't increase the dividends, then that percentage will go down, and that percentage is called the yield. There are higher yield ETFs like REITs, which are real estate investment trusts. Usually they pay 2 to 6% yield. In return, they get taxed on a higher bracket, so basically it's the same thing. Some of them are like an outlier. For example, AT&T right now, it's the highest yield. But if we look at AT&T price, so this is AT&T price, and as you can see, since 1995, price did nothing. So you basically got paid dividend, but the price went nowhere. Some companies do keep up with their price share, so when the price goes up, they increase the dividends paid, so they keep the same percentage, the same yield, like Coca-Cola and Procter & Gamble. And of course, some other companies, they don't, so then the yield starts to go down when the price is going up. Of course, the reason being is you're getting appreciation on your share price, so it's okay that you get paid a little. Okay, now we understand what dividend is. Basically, it's yield paid on your invested amount. So let me give you the main 3 reasons why you shouldn't invest your hard-earned investable dollars in dividend stocks. Reason number 1, companies who pay dividends usually are not growth stocks. So that means they're done, they expanded at the most, and now they cannot grow anymore, so their price is going to hover at the same level, so they pay you some dividend yield in order to entice you to hold their stocks. So in that case, your target is for the stock price to stay the same. You're getting paid dividend on that price, assuming it's going to hover at the same price. So then your yield is minus the inflation, which is going to be, let's say, around 2.5%. So 2.5% return on your investment is a crappy return, and you should not accept it because there are many options available to get more. So why you should settle for less? Reason number 2, that some investors think that it is safe to invest in these dividend stocks because, they've been in the market for a long time. They will not go bankrupt. There are many good companies that at one point in time go bankrupt, or probably they just lose so much that it doesn't matter how much dividend they are paying you. So take Microsoft, for example. Let's say you bought it here and you are looking for the dividend. Microsoft is a good company. It will never go bankrupt. But look at this. If they're paying you 2%, the price you bought 50, now it's 32 at this point in time. This is 12 years later. So 12 years later, you're holding that stock, you're getting paid 2.5% or even 4%. Okay, you're losing for inflation 2.5%, so you're making 1.5 to 2%. In the meantime, your account depreciated by 50%. Well, what about Invesco? This is Invesco Mortgage Capital. And look at this. These guys, they're paying good yield. And then suddenly they get a price shock. And look at this now. They started at 20 and now they are trading at 3.2. Okay, they didn't go bankrupt, but they are 3.2 now. It doesn't matter how much yield they paid you since 2010. You cannot recoup your investment now. If your price doesn't appreciate 500% from this level, then you'll never recoup your initial investment. It doesn't matter how much dividends they pay you. So yes, even if you invest in sound, good companies, the price can go 50% down. So even if you invest in sound companies, you still can lose a lot by just taking the dividend yield as your investment decision. So you might say, okay, well, how about I invest in Apple? It's a growth stock, it's doing very well, and it pays dividend. So you can see this is the adjustment for dividend, and it's nothing. Okay, it's not significant at all. And why is that? It's because in a growth stock, of course, dividend doesn't matter anymore because dividend is 2.5%, and the growth is like 300%. So if it doesn't matter, why take it into the decision of investing? Then you should look at normal investing. You should not look at dividend. If there is dividend, then it's just icing on the cake. But it shouldn't be your starting position. I want to invest in a dividend stock. Finally, the third reason is in order to generate significant income, you need a significant starting capital. So let's look at this example. Let's say you have $25,000 and let's take the highest bracket, 5% dividend yield, and you're holding for 10 years. So if we calculate the returns, then your income is $1,273 per year on your $25,000. Obviously, what you're gonna do with this $1,200? You cannot live on this $1,200. So let's say if you are living on a $50,000 a year, in order to generate $50,000 a year, you will need what? You will need $1 million account. So if you have $1 million account or $25,000 account, why you're accepting this abysmal return and taking still all the risk? Remember, you're investing in companies which risk is not zero. There is risk. At least there is a risk of a huge drawdown, like 50% drawdown. So even if the company is sound, let's say we took Microsoft, for 13 years, Microsoft didn't do anything. So your money is not only stagnating, it went to 50% for 13 years, okay? In the meantime, you're getting abysmal 2% return on your investment, while the total investment went down by 50%. Yes, the company didn't go bankrupt. And also the other myth is this is passive income. What's passive about it? This is hard-earned cash. You know what's passive income to me? Passive income is, let's say, I don't know, you painted a picture. You scanned it, you sell it on Etsy. That's passive income to me, okay? You did something once and you keep receiving money on it. That's passive income because that piece of paper worth nothing. But your money can do something else. It's not like you made this money and now you cannot do anything with it. So, oh, let me generate passive income. No, you can invest it. You can start a business with it. You can do many things with it to generate more yield on it, rather than the 5%. Let's say you own a real estate home, and also people call the rent is passive income. But again, that's not passive. You invested cash in there. Once you invested cash, that's it. You took some risk. So now you should look for the highest return compared to that risk. So this is not passive income anymore. You are taking risk and accepting return for that risk. If you're accepting 2%, 4%, then you are being conned into something. I don't know who came up with that idea. Definitely the banks, because the banks is the only one who are making money on real estate. But that's for another video. Let's focus now. Okay. I hope I convince you now with those 3 big reasons that you should not invest in dividend incomes. So, okay, now what do? You have some money to invest. Most people will say, well, you should invest it in an index fund like the S&P 500, and it generates roughly around 7% a year, which is true. But you're accepting, again, 50% drawdowns and stagnation for 10 or more years. Again, the S&P 500 did stagnate for 13 years, since from 2000 till 2013. So while this is a step up from dividend yield, but it is still, I mean, if you're watching this channel, you should demand more return for your hard-earned cash. And now I'm going to give you my most favorable investment as a starting step. This is not the ultimate investment. This is a starting step for anybody with any amount of money, be it $500 or $500 million. So let me show you this simple, extremely simple system. This system invests in the S&P 500. It goes long when the price above the 10-month moving average, and it sells when the price goes below the 10-month moving average. That's it. There is nothing to the system, no stop loss, no profit target, no nothing. This system, and I have data here since 94, traded about 1 trade per year. So it's really good for capital gains. And look at the returns. So the S&P 500, if you put your money in it, it will return 383,000. This one returned 410,000. Okay, it's not a lot more, but what's really significant, number one, is this. .com crisis, 50% drawdown. Subprime bubble crisis, another 50% drawdown. COVID crisis, 30% drawdown. Our system, the largest drawdown was 16.6%. That's number one. Number two, rolling returns. Of course, no amateur will show you this. This is only professional people know about this, but you should know because you're watching this channel. Rolling returns are an important factor. What does that mean? That means if you're holding this investment for 3 years, what do you expect? In the S&P 500, we expect minus 16% or plus 30%. We don't know. Anywhere between minus and 32. And 10 years in the S&P 500, we expect anywhere between minus 3% and 16%. That means you start your investment, 10 years later, you cannot forecast the future. 10 years later, you only know one thing. Your investment could be worth minus 3% or plus 16%. Okay, that's the rolling return. Compare that to our simple system. At 5 years, that's it. It's always positive. 2 to 23, at 10 years, 5 to 14, at 15 years, 7 to 12. So these two significant higher KPIs makes the big difference in this system. So don't look at only the returns, okay? You need to look at the drawdown and you need to look at the rolling returns. This is 5%, which is the extreme end of dividend yields. If you invest $25,000 in 20 years in 5% dividend strategy, you expect your account to reach $66,000 after 20 years. If I plug in this number, which is 10.62, look at this, your account is 188,000. So that is 7.5 times your initial investment instead of 2.5 times. And instead of going to 66, it goes to 188. And this system works even if you want to add weekly, daily, monthly, more money any time of the year. You can add to the account and it will still perform much better than the S&P 500 alone, and of course much better than any dividend portfolio. And of course in my Discord server I have tactical asset allocation portfolio, and to give you the difference what that makes, so same 25,000, if I plug in 16%, now it's 486,000. If you plot that on a curve, that's an exponential curve. Meaning if you go from 5% to 10%, you don't double your account, you triple. And if you go from 5 to 15, you don't triple your account, you go to 19 times your account because the curve is exponential. So that is the trick of math. If you know math, then you make it your friend, and then you know that 1% actually a year have a huge effect after 20 years. So keep that in mind. And of course, if you have any questions, any comments, please do so below the video. I'll be more than happy to answer all your questions, and especially for those invested in dividend stocks. I hope a light bulb went in your brain. And of course, if you want to take this further and be part of my inner circle and get the signals for the tactical asset allocation portfolio, then you are most welcome to join our Discord server through the Patreon link down below. As always, good luck with your trading, good luck with your investing, stay safe, and I'll see you soon.